good morning, good morning, and welcome to IPSTN Talks. My name is Alicia Green, the CEO of IPS and the host of this series. Now, IPS is a consulting firm that offers a wide array of services in specific areas of business development, digital solutions, project management, accounting. We have an admin support desk and a slew of other products and services we know that you will be interested in. So instead of me spending a lot of time going through that, check us out online at IPSBVI.com. And we'd also like to encourage you to follow us on our LinkedIn page at Integral Professional Services BVI Limited. Now, this morning, we are very excited with our guest that will be discussing a perfect investor. Now, is there such a thing? He will let us know all about it. And just to let all of viewers know that TN Talks is our platform that's used to engage in discussions around hot topics as it relates to solutions we provide as consultants. Now, in studio with me is Brian Alexander, who is a wealth manager. He's resident in Mauritius now. He used to live in the BVI for a short time, but I'd like to give him an opportunity to tell us a little bit about himself and his company before we jump into the discussion. So Brian, welcome to TN Talks.
Thank you very much. Obviously, my name is Brian Alexander. I'm with VFS International in Mauritius. We are around Africa, Europe, and we're in the BVI. So I obviously here because I have a substantial amount of clients in the area, and that's why I've popped in to see all of my wonderful clients. But from that side, we are based around wealth management and trying to advise and assist you to basically grow your wealth. And I think that is a good enough focus, is to make your money grow and grow and grow. So that's pretty much me.
That's fantastic. Well, I hope everyone has their cup of tea because it is TN Talks, and we are gonna get started. Again, last time we were here, Brian, we were talking about cryptocurrency, and it's a question that we get a lot from our clients, really trying to understand that particular sector. And they're also seeking alternative investment strategies, especially today where people are really trying to grow their wealth for the future. And now here we are today talking about the perfect investor. Is there such a thing? I can't wait to hear what you have to say about that. But before you start talking, I want everyone to know that if you have a question, just put your question in the Q&A box. I will be paying special attention to that so that we make sure that Brian addresses all your hot questions today. And at the end of the session, there will be a short survey that we'd like for you to complete. And also, if you would like for one of us to get in contact with you, that's where you can put your contact information. So with that being said, Brian, let's start talking about what is or what should be your motivation for investing.
Okay, so the motivation, I think really for all of us, we need to actually have a motivation. So we need to determine and drill down to why are we actually investing. Why there are two different things. There's saving and investing. Do you know there's a difference between the two?
Yes.
Well, let me tell you. Okay, just tell you. Saving is literally keeping the value of your money. Mm-hmm. So it's putting it aside and trying to keep the value of your money. Investing, on the other hand, is beating inflation. So there's a slight difference between saving and investing, but there's nothing so technical about it. But what is your motivation? So, in other words, what are you aiming towards? What is your goal? What are you trying to achieve? So I think I'll just give you some sort of idea. Many times I've asked my clients, what is your goal? And they'll say, well, save towards pension. Okay, so how does it look like? And they will say something like, well, I'd like to have a great pension. I'd like to cruise around on the cruise ships a little bit. And that's what my pension is going to look like.
Mm-hmm.
So that's wonderful, great. And I'm speaking about one specific field now. There's obviously various different things you can look at, but we're just going to utilize this one. So my next question would be, so therefore, how much monies and wealth would you need to be able to do that? And that's where anything up to 95% of the people say, I actually don't know. That's where they get unstuck. Yes, I would love to be able to get my child to a great education. Okay, so what's that going to cost? Well, I think $80,000. Okay, so how much have you got so far? And how much are you saving so far? I don't know, $200? Is that going to make it? I don't know. So we often don't have the motivation, the right motivations and the right goals set to be able to actually achieve what we aspire to achieve in our financial field. And it goes right across from everything to saving for a house, education savings, pension savings, all of it. So we need to understand, what are we heading towards and what is our motivation to be able to, what are we trying to achieve?
Okay.
Does that help, Alicia?
That's the very first thing that we need to identify, and it is a very critical question to answer, you know? So how do you, after we've identified and gone through that, for example, if you have a client that really can't identify, well, how much do I have, based on my motivation, what would be your next step or next point after that?
Okay, well, it's with any sort of financial planning, there's always going to be a lot of questions. So, and we're talking about the perfect investor. So to be able to get that, and I would say there's maybe 5% of perfect investors in this entire world. And the reason is because they don't know the ultimate end game or the end goal. They have no idea. And a lot of them, a lot of those 95% of people are actually saving. They actually are investing. They're doing one or the other or both. But somehow they've not looked down the road to see what is the end game. So it is extremely important to understand that. Once they've determined that, it's not difficult by asking a few questions. And then I'm normally able to determine, okay, fine. So, for example, let me help you a little bit more practically. So in the next question, the person says, well, I'd love to be on pension with traveling the world. Okay, so what does it look like in today's value? Because everyone doesn't realize what the value is going to be in 10 or 15 or 20 years' time. So I then say, okay, fine, let's not worry about then. Let's be concerned about now. What do you need to live on now? Don't worry about that. What would be comfortable now if you went on pension? Now. And you obviously didn't have child's education to pay for, and you didn't have a house to pay for any longer. What would you need in today's terms? And then the person says, well, that's easy. It's $4,000 a month. And I say, okay, that's all the information I need. Now I just move that down the road according to inflation and go, that's what you need. Therefore, that's what you need to save. It's not that different.
That's what you need to save, but that's what you need to invest.
Exactly. Now you know what you need to invest, whether it be a lump sum, whether it's be a monthly contribution. It depends on how you would like to do it. But at least you then understand what you should be doing now.
Excellent. I like that. I like that. That's actually very straightforward, Brian. So now that we would have passed that threshold, how do you determine what's the best investment for the
Okay,
client?
that is not as easy as it sounds.
Right.
Okay.
I suspect because you're using the word best, and I know that best mean different things for different people. So I will let you address that.
Okay, well, that was a very good 15-second answer to my the way I was going to answer it. But so in the end, it is there is no typical best investment that just goes across the board for everyone. It's never going to fit. And let me give you the reasons why, so and this is what you need to understand. So if one person comes along and says, crypto is the best investment that you can do. And it is for them. And maybe for someone else, and maybe for the next person and the next. But there's a couple of things that come into play when doing investments, and it's across the board. It's not just with crypto, it's with across the board. Okay. And that is this. What is the time that you have available to be able to achieve that goal that I just was speaking about? Is it 5 years, 10 years, 15, 20, or 30?
Mm-hmm.
Because that time span allows you to take more risk. The shorter the time that you have, you're not able to take as much risk. If you do, you could either come out winning or totally losing. Now, that's a challenge that you've got to meet. So the one challenge that you've got to face is time. So what is the time that you have on your hands? Secondly, the other side to it is a matter of risk. Now, I've sort of alluded to the risk. You can take a little more risk if you've got a longer period of time. However, if you're not a person that likes risk, how are you going to take a product that has a value of risk to it? How are you going to invest in it because you're not feeling secure? I was with someone yesterday and they said, I feel a little bit about that. I don't, because their risk appetite is not there. So the easiest way, especially if you've got a longer period of time, is to invest within your risk appetite. So that's the second thing.
So what are some of the alternatives then based on, let's say, low, medium risks, especially if someone's kind of testing the system?
Okay, so I will get there and I will explain and there. So you've got, firstly, you've got the idea of risk, you've got the idea of time, and you've understood clearly what is your goal. Now it's a question of, okay, so now that I understand all of that, and I've got a very clear indication of where I'm going and how I feel about that investing and how I feel about risk, I understand that clearly. Now that I've got that, I've got to understand what product fits that.
Absolutely.
Okay. So every advice from the various different angles is sometimes good, but sometimes doesn't sit well with you as a person, okay, and what you're trying to achieve. So from an investment perspective, there are a few different options that you have. So you've got, if you want to be a little bit more cautious, you've got things like notes and bonds. You can opt for that. You can also opt for the bank, but that's not going to make you any money, obviously. But you can opt for anything that's on a fixed return. So there are products in the market that'll give you sort of fixed returns, anything from 4 to sort of 10% returns, but that are fixed. So you have the guaranteed fixed return. With those, normally there's a fixed amount that you need to invest in those. So they slightly vary, but a lot more secure and you know that in 2 years or 5 years time, you're going to get a 6 or 7% return, and it's got nothing to do with the market whatsoever. So there's a product, but the person might say, but I need to make 15%, not 7.
Right.
Well, then that product is then probably not for you. So then there are things like you can go into funds, which and you get index funds. Those are sort of go along normally at around about 10%. However, at the moment, 2022, it is not the case. But what you've got to always remember with the market, when there's a flexibility in the market, when you're not having a set return, the market is going to be emotional and will react in a negative fashion once every average 4 years. It's normal. Mm-hmm. Life does not just go in an uphill fashion all the time. If that is the case, and you've started when you were 10 years old and you're now 50 years old and life has just gone perfectly upwards, then you're welcome to raise your hand on this and raise your hand. We'd love to meet you. So, and that's the same with the markets. The markets have a tendency to have around about a 20 to 30% negative with about a 60 to 70% positive. Okay.
So based on what you're saying, then it's strongly dependent on your risk appetite.
Absolutely. Okay. So within the markets, you can take more cautious investing, and you can also take the more aggressive investing. So, and then what I've just mentioned, there are two that I've really mentioned at the moment, and you can mix that up. So you don't have to go all into crypto, all into mutual funds, or all into notes and bonds. You don't have to have just in your entire investments into just one particular thing. It's actually better anyway that you diversify. So again, it's understanding when I'm starting to talk, it's starting to get a little bit technical now, but that's why you really have to understand what's my end goal and what's the risk that I'm prepared to take. That's the importance of it. If you get that right, then the product can easily be fitted into that scenario.
Excellent, Brian. I want to go back to something you mentioned in terms of the client having time, because timing is also very important here. And when we speak to clients, there are varying age differences. We have the 18 to 35 year, the youngsters that are probably just starting out working. And then you have those that are 40 plus, 50 plus. Let's say that, there was you're 40 plus and you didn't really have a pension plan set up. What would you recommend, or how would you advise that particular client on setting up based on the amount of time they have left and what their potential end goal would be at, let's say, retiring at 60?
Okay, so if a client is, I'll give you a quick sort of scenario. If a client has around about 35 years, 30 years plus, generally the percentage to be able to come out with the same income earnings at the end and have the same standard of living at the end at pension as what you're having anywhere through your life, you would need to invest around about 15% towards your pension. Mm-hmm. Okay, so that's getting a return of around about 10% returns per annum on your investment. So in other words, if you currently are employed and you are contributing towards a pension fund of 5%, your employer 5%, you're on 10%. In other words, you need to contribute probably about 5% of your income.
Okay.
That's if you've got 30, you're going to end up with 30 years plus of service. If you're on 20, then you're going to be moving much closer to about 18 to 20% of your income. So if you're paying 10 with your employer, together with yourself, then you need to be putting in 8 to 10%.
8 to 10.
10% of your current gross.
Got you.
Gross, because obviously there's going to be a tax implication later on as well. So you can't go to net, you've got to go to gross. So then you will need to contribute around about that to be able to achieve an average same living as a standard as what you currently have. So that's pretty much the idea. But you've got to keep in mind, and this is really crucial, when I say these percentages, I'm assuming that the pension fund that you're currently on is making a return of around about 8 to 10%. So if your pension fund is making 2%, suddenly the whole formula changes because you're not making enough out of that. And then the formula starts to change quite drastically. You need to make, with my assumption, you need to make it around about 8 to 10% return. So let me give you some good information. Mm-hmm. Never just accept the return of where you are standing on your pension fund. Just because you're contributing to it, it does not mean or guarantee that you're going to get a great payout. No guarantees. Unless you go and scrutinize, and some of the companies, when they offer you a pension, they give you a couple of options. They might give you 3 different options. You can choose between a more cautious to more aggressive.
So this is the reason why you get people.
What is the return? Sorry.
Go ahead.
Yeah, you need to be aware of what is the return on your actual investment. So there needs to be advice, whoever's running that particular pension fund for you. If you're not getting the advice, you simply just ask for a statement and you can give it to me and I'll tell you exactly what you're getting on that. Don't want to be surprised in 30 years that you didn't end up with enough pension fund and you were contributing very faithfully for 30 years and then find out that your pension fund doesn't fit the bill.
So what would be your advice? Let's say that, we've had the pension fund, but we're not happy with the return and we want to do something else. What is the best way really to go about with the alternative investing while you still have your pension fund? What are some of the other platforms?
Okay, so you've got a few options. You can do a straightforward investment and you set a term to it. So if you're going to be investing for more particularly, say, a pension, then you don't want to have a liquid asset. Okay, in other words, it's readily available. You pop down to the bank, you draw it out, and you go buy a car, which is not an asset. It's a liability. It's depreciating. Nothing wrong. You need a car, but at the end of the day, if you're saving for a particular thing like your child's education, you don't want it to be accessible. In other words, I can simply go draw it out in 5 years' time and deplete all the savings that I did, and now I must start again. But now I've only got 10 years left to save for my child, or 5 years. And it now becomes extremely difficult because there's the thing with time called compound interest. Mm-hmm. So the more time you have, the better you are. And compound interest really starts working effectively in around about year 8. Okay. Then you see the graph of compound interest start to really go and start shooting up. So if you start taking your money out at 5, 6, 7 years, you haven't really seen compound interest beginning to work.
Makes sense.
Okay. Year 8, if you're investing, you will see if the return is average, you'll find that the amount of interest that you achieve in years 8 will be about the same as what you're contributing per month, per year, and sometimes even more. So that's when you start to see your investments start to really accelerate and grow.
Time, patience.
Time, patience, and strategy.
Yes.
If you don't have a strategy, you'll find that you'll invest, and the next minute, I'm sure it's at least two or three or four of you can probably raise your hand up and said, I've invested for 5 years or 6 years or 7 years, and then suddenly I spent it all.
Mm-hmm.
Okay. Now, there's nothing wrong with that, but at the end of the day, what was your goal for that investment? What were you trying to achieve? And that's why I say, if you're going to do something like an education or a pension, put it into something that's fixed, but you cannot access that.
Yeah, Brian, as you just talked about goals, I know we have some young entrepreneurs that are here with us today, or who will be watching this after. And a lot of them are seeking alternative investments to help grow their businesses, or even to start a business, because one of the challenges we have here is funding small business. So would you say, or would you recommend this type of alternative investment to them? And if so, what would be a potential strategy and solution that they can use?
Okay, so let's say we have a time span of, say, 5 years. They have a certain amount of available cash that they want to save over a period, and it's a 5-year set period. Then I would probably indicate that to be on a platform, so you can actually go onto a platform, and that platform will give you the facility to be able to trade in various different opportunities, and you can spread those opportunities. And the thing is with the young people nowadays, they're wiser than about financing, actually, and all these tech facilities and how to grow money and what things to choose. And so with a little bit of help, they can certainly achieve some decent returns over a 5-year period. They can contribute money on a monthly basis or every 2 months into that investment. So a platform is certainly one of the good options that I would say. With a 5-year term and a shorter term to be able to grow to a point where they want to actually open up a business, then I would be saying that's probably one of the best routes to follow. You don't want to be in anything that's fixed with a fixed term, because there are generally too many costs involved. And the only persons that come out on the better side of that is generally the likes of myself and the company that I work for. So the platform is a much better option because there are very little cost involved. And there's a lot more opportunities to choose from, that you can have up to 400,000 different instruments, including the likes of crypto. Now, you don't want to necessarily put everything into crypto. That's my opinion. But you've got this opportunity to be able to invest in probably 100 different cryptos. Mm-hmm. At the same time, you can go into ETFs, you can go into funds, you can go into any particular stocks that you like. So there's a lot of opportunities where you can diversify across the board and actually make a decent return. Now, the wonderful thing about this is this, especially at the moment. So most of you that are sitting on your going, the market's terrible. No, let me tell you something else. The market's not terrible. The market is fantastic if you're about to start investing, because you're going to get everything at a very, very low price. Okay. You want to, if your name's Warren Buffett, he's buying like crazy at the moment. You don't want to be getting on the bandwagon of a particular stock or something that is doing exceptionally well. Okay. You want to be looking at those that have got a good value in them. In other words, that there's great potential going ahead. It's undervalued at the moment. Okay. But can I add in something there? Just be careful of buying you need to be very careful about buying a cheap stock that has a terrible, in other words, that particular equity or stock has a terrible cash flow. They're in serious debt. Okay. You don't want to be investing in that. So okay? There's no potential to get back to where it should be because there's no cash flow to generate that business. It's the same as our own lives. It's very difficult if you've got no cash in the bank and all you have is debt. And there's a tough time, then you'll find that you're going backwards and not forwards. But if you've got a decent amount of cash flow to utilize in a market that's tough, you'll find that's the person that's going to excel.
That makes a lot of sense, Brian. We got a couple of comments. One says, buy the dip. And another good comment here saying, yes, buy low and sell high. And there's a question. Wouldn't you say that the ratio should be more 20% rather than 10% based on today's market? Question for you.
It should be more 20%. Can we clarify what they are saying? 20% of what? Should it be more 20%?
Than 10% based on today's market. I think you're talking about the ratio for investing. And if you're there, maybe just you're earning, yes, based on what you were saying earlier about how much to put into the investment. So they're asking if it shouldn't be.
If the market, so if the market is down, it's the more you invest, the better. Okay. Let's clarify that. The more you invest, the better. However, when the market's down, you're going to get more value or the same value at investing 10% as what you're doing at investing 20% when the market is right up at the top. So you're going to get the same value. Okay. But I was talking about, when I talked about the 10% investment towards your pension, I was saying that's at least the idea. That's not the total formula beginning and end, because we all have different goals and they differ slightly. Yeah. And what we aspire to have. So it might be 11%, it might be 15%. And some people say, well, I'm going to invest 20 anyway, just to make sure that it is secure and that I have more than enough. Perfect. That's perfect. But you'll find that most people that I speak to, between their pension fund and what they're investing towards their pension, does not even reach 15 or 20.
I got you. Understood.
Most don't. So if we could get everyone just to at least get to the 15, 20, well, then we can move them to 22 or 23.
I got you.
There's no loss in the more you invest, obviously. So the comment's good. The more you invest, obviously, the better. I'm just not trying to take your money off you just for the sake of taking your money off you. I'm trying to strategize to make sure that you have a good idea of what at least that you need just for the basic.
So a couple more questions for you. One is, based on your experience and expertise in this, what has been some of the more popular investment strategies that you have seen work for people? Okay, well, that is quite easy to answer. Probably around about 60% to be in a fund that has a history of around about 10% growth over a longer period of time. So we're not looking for some fantastic growth and we are just trying to have this $1 million by tomorrow. Okay. The likes of Warren Buffett, they will tell you as well, and there are many others that will tell you we invest to hold. We don't invest to sell tomorrow. So with a long-term strategy. So
invest into stocks that have got a good cash flow, a good history of returns, a stable returns over a longer period of time. So I would say 60% of your funding should more or less should go into that. And then you can speculate with about the 40% of your monies. And that, when I say speculate, you can look at the likes of crypto. That's certainly, and right now, and actually, in fact, today it dropped another 10% plus minus. So you can look at the likes of crypto. So certainly that's an opportunity that a lot of people are speaking about, and it is definitely something that over the last 10 years, because it's been going just over 10, is certainly that needs to be considered in your portfolio. Not all of it though, but certainly some of it.
Mm-hmm.
And then I also like to put something into notes that are guaranteed, so that you know that you're getting a 10% return on your investment, and it's guaranteed, it's fixed. And you can measure it. You don't have to worry about what happens in the market. And I would certainly add that. So I would say I would put a 20% into notes and another 20% into the likes of crypto and any particular stock that you might fancy that has a good return on it. There might be a fair amount of risk in it, but there's a good return on it.
Well, I have one last question for you here along those lines. What are your thoughts on blue chip stocks?
What are my thoughts on it? Well, your blue chip stocks are really within your index. And so in principle, to comment on that totally is a difficult one because of the changes that we've had this year. So I'll give you my honest opinion that I was telling my clients at the beginning of this year, and that is start moving a lot of your investments out of tech. Now, a lot of your blue stock is in tech. Mm-hmm. So not all of it, but there's a lot in it. And I really honestly moved my clients' investments down to a maximum of 15%. In the tech side, because of the Fed hikes, and it's going to affect those particular companies. So I'm more into commodities when it comes to your stocks and to your equities, more into commodities and consumables, renewable energy. What else is there? Yeah, those are three. Of course, health. So those are the sections that are doing exceptionally well. Not all of the stocks in it, but a lot or most of them. And I would certainly be looking at those sectors than just blue chip. Blue chip is in the indexes, and the indexes are down by 20% on average. So I wouldn't just put in to the blue stock, and I wouldn't.
Understood, Brian. Thank you. Well, we're just about at our 3 minutes left, and I just wanted to have you leave any last words of advice for the audience on investing and how they can be the perfect investor.
Okay, I think I might have to repeat myself, but that's fine. And if you might have missed it, it's good. Let's tell you this: perfect investor is going to differ from one to the next. Mm-hmm. The perfect investor is going to look like this. I have a very clear strategy for my personal life. It's got nothing to do with anyone else, and their strategy is theirs, and it's going to differ from mine. There's no doubt about it, because I have a different time span to it. I have different goals. I'm married. I'm not married. So I have different aspirations. So therefore it cannot be the same. So be clear about your goal and your strategy. Be very clear about it. Define it to the last degree. Don't just say, it'll be nice to have lots of money. That's not good enough. I want to earn lots of money. That's not good enough. I want to get a decent return. That's not good enough. Okay. If you say I'm needing a 15% return, now we need to then look for that, what you're looking for. Now it's much clearer. I want a 15% return per annum on my monies. So be very clear about your strategy and what you're trying to achieve, because when you are, then you're able to actually find the products that fit that. And if you can't, then there are people that, like myself, that can help you and say, right, for what you're trying to achieve, here's the perfect product, and it will differ. So I think that's the biggest thing, is to get a very clear strategy, because if you do, you'll become the perfect investor.
Excellent, Brian. Thank you so much for that. Listen, you've given us a lot of information today, and we're going to definitely, if there's anyone that wants to connect with you, we'll definitely set you up as their advisor on this particular subject. And what I'd like to do now, ladies and gentlemen, thank you so much for tuning in to our TN Talks this morning, where you got a chance to hear Brian Alexander talk about being the perfect investor. We would be happy to be the conduit to help you out with your wealth planning, your wealth management. So again, this is Alicia Green on IPSTN Talks. You can follow us on LinkedIn. Check us out on our website, IPSBVI.com. For now, we want to thank you for tuning in, and see you next time on TN Talks for another hot topic to help you to grow and build your business. Thank you for tuning in.
Thank you so much for your time.